When we think about safety, we have to think about that as purchasing power. Because a lot of people think if I put my money into a treasury bill, I get safety. Look at whether that's giving you a return that's compensating for inflation. And maybe we're all wrong. Maybe there's nothing to worry about. So how do I deal with that? I want you to get balance. I want you to have enough savings. Have security. I think investing, which is the same as savings, comes in tiers. Tier 1, Tier 2, Tier 3 on risk. And the first tier is if everything goes wrong, I'm okay. And everything could be inflation, depression, anything, whatever it is. I lose my job. Whatever it is, I got that thing covered. Then your next level is, okay, what am I going to get the highest returns? What is my best bet? But start at that level. And then it's not just the investment. It's where am I? Am I in the middle of a fight? Like, I don't want to be in the middle of a fight. What's it going to be like? For people that don't know your background, you have a meteoric rise. You're in your 30s on top of the world, unbelievable success. You made a huge bet on a collapse and it didn't play out. And it ended up that the market went up and you lost a lot of money, almost lose Bridgewater. You come up with a new strategy. It ends up getting tested multiple times in the market. And you guys crush when other people struggle. What I learned from basically this hunch in the face mistake. How to make good money without having big loss. I learned how to improve my return relative to my risk. The holy grail of investing is 10 or 15 good uncorrelated return streams. You get that and you will have a similar path to the path I've been fortunate enough to have. Something comes along all the time for anything. Everything has its time. You put your money in any one thing, you could think, okay, movie theaters are good and then you get COVID, or cruise lines are good and then you get COVID, and whatever it is, it's good. Well, it's good sometimes, but there's always something that always is going to mess up the one thing. So you don't want, like, in my opinion, you don't want more than 10% of your money in anything. And they want to be good, different things. And that's the message I'm trying to convey. I look at three major forces that are happening now. Haven't happened in our lifetimes, but have happened many times in history. And those three major forces are the creation of a lot of debt and the printing of a lot of money to buy that debt, particularly because the government is running large deficits. They don't have enough money, so that government has to print that money. So that creation of all of that debt and its financial implications and its economic implications is one force. The second force is the internal conflict, the amount of conflict that's largely due to the largest wealth gaps that we've had since. That produces populism of the left and the right, particularly when there are financial difficulties. The third force is the rising power challenging the existing power, largely in the form of China and to some extent Russia. Let's call it the Great Power Conflict, because in 1945, there's a cycle. You have a war, and after a war, you have winners. And the winners determine the rules of the game. And then there's this evolution of others becoming more competitive, and then you have a conflict again for who's in control. So we have that dynamic taking place. So those three influences, the financial, the internal conflict, external conflict influences. I learned before that when I was surprised. Often it was because of things that hadn't happened in my lifetime before, but happened in history because of that reason. I went back and studied history the last 500 years on these cycles. There are big cycles that last about 75 years, give or take about 50 years of rises and declines. I think it's so important people understand. I also learned in studying history that there were two other influences that were very big, and you could see them. The first was acts of nature, such as droughts, floods, and pandemics. The changes over time and the evolution over time of people's learning and the technologies they make. So I'd say there are really 5 big influences that drive everything. And since they each affect each other, it produces what I call the big cycle. So as we go now into this, it's important. One man's debts are another man's assets. So what happened? Government had to sell a lot of debt. When it sold a lot of debt, there were a lot of entities that bought a lot of government bonds. And money was very easy, which meant that short-term interest rates were very low and money was it was actually being given away because they had interest-only loans and interest rates were less than 1% and you didn't have to pay back principal, so you could go get money. And so that created a lot of debt and it created buying of government bonds. What happened to many entities all around the world, not just banks? What does a bank do? A bank takes in deposits, typically, or debt in some way, and then it buys debt. It can do that in the form of making a loan, or it could do that in the form of buying a government bond, buying debt. And then, when interest rates went up, the value of that debt went down. Money they had to give to depositors became more and more expensive, and also depositors wanting them to be competitive looked at money market rates or other rates and withdrew money from the bank because they had better uses. Okay, so what that leaves them with, it's a banking problem that has happened literally for thousands of years. What they do is the depositors, want their money back, and they're holding assets that, in this case, have gone down in value, so they're broke. What happens for the economy as a whole is then they print the money. Because they don't want defaults. There's a tolerable amount of defaults, and then you get past a tolerable amount of defaults, and it just crushes everything, and so they print the money. It's not a banking issue. It is a global issue all around the world. Pension funds, insurance companies, the world is leveraged long. Long, meaning they own stuff, and they borrowed money to own it, and it's going down in value. The big issue is the government can come in and print the money and give money to anybody they want to give money to. But when they do that, that typically devalues the money. Think about it. If you're holding a bond, you got a claim on money, but the claims are too much. One way or another, you're either not going to get back that money in full, or you're going to get back money that's worth less because they print the money. But if the money's hard, if that's going to be good money that's coming back, it's going to be hard for those entities to pay back because it's a lot relative to their income and cash flows to pay it, and that means that the default risk rises. However, it means that the debt will be bad one way or another. It's either bad because they don't pay it, it needs a haircut for them to pay it, or because they do pay it with money that is going to be printed to come back. So think of it this way. I just want to make this clear. When there was the position that interest rates got a lot below the inflation rate, you're losing buying power. There's no good reason to own that. And there's a change in psychology because before there was, I own bonds, I'm getting a price appreciation, even though I'm getting, let's say, a low interest rate. But inflation isn't a problem until it's a problem. Then when it's a problem, because they print so much money and they put it out, then inflation goes up and a light bulb goes off. People realize it's not safe, I'm losing money to inflation. And then the other side of it was you want to borrow and buy stuff because money's free. So companies borrow and buy stuff. And individuals borrow and buy houses. Interest-only loans on the houses. I mean, okay, I can buy a house, I can buy an apartment. But that creates the imbalance where it's terrible to be a lender and a creditor. And it's good to be a borrower and do that. The Federal Reserve says, I better fight inflation. They change things. And so by raising interest rates, real interest rates much higher, lo and behold, all the people who did all those things get hurt. Because yields got so low, tech companies and others, those who have a dream, they don't have to necessarily make profits. They're selling a dream and the money's got to be invested. You see all of that change radically when that tightening of monetary policy. So now you sit there and have a loss. What is the value of a financial asset? It has no intrinsic value. Its only value is what it can buy. But there are many more financial assets out there there's ever been relative to the value of stuff to buy. There's too many claims out there. It's like musical chairs. If everybody says, oh, wait a second, let me get my stuff. Let me convert my debt assets. I want to get real stuff. That's a real problem. And so that's the global picture on the first of those 5 influences. The fact that it's happening with the other influences is very important because they affect each other. So this financials picture, by the way, is the same as in the 1930 to 45 period and the same as they were throughout history. For people that don't know, that's World War II. It started with a financial crisis that then caused internal conflict. What do we do about the financial crisis? The populism of the left and populism of the right in this internal fighting. And 4 countries that were democracies chose not to be democracies because of the conflicts that were existing. And those countries were Germany, Italy, Spain, and Japan, because there's a lot of internal conflict over wealth when you have that. And so that creates a lot of internal disorder, in some ways almost civil wars everywhere, some form of civil war. And of course, that happens also at the same time as there's the external conflict. First of all, everybody's fighting over resources. You have populists come to power, and the populists are not compromisers the way democracies work. And you've got to pick a side. There's no place for moderates, and the sides are, let's say, internally in the country, the left and the right, and externally, the Americans and the Chinese. And you've got to pick a side and fight. That becomes the dynamic that is these periods of time. And these periods of time have typically lasted about 10 to 15 years, and they have various symptoms to it, like a disease, like a cancer. You see stage 1, 2, 3, 4. If you have these things, you can look at it and you can diagnose, and you see it moving from stage 1 to 2 to 3 to 4 to 5 and to 6. You can see that taking place. And each time you come closer to a bad set of circumstances, bad financial circumstances and bad fighting over things. The dominoes are beginning to fall. I mean, you know what the next dominoes are. For example, they're not going to buy the debt. Those who bought the debt and have too much debt and have debt losses on government debt are not going to buy more of that debt, for example. And therefore, when the government sells more of the debt, there's not going to be an adequate number of buyers for that debt. You know that those who are hurting because they have those losses won't make loans. And a lot of those loans went to real estate, particularly commercial real estate. And you know that for various reasons in commercial real estate, we don't use it the same way and so on. So you're going to have problems in commercial real estate. You know, as a result of these things, that a number of entities will cut costs in their various ways. And so depending on that, the job market is changing. You know, you see it, for example, in tech jobs. If you're in some of those areas that are getting squeezed, and you see the same thing, by and large, happening internationally, that value has gone down a lot. And because it is bought on leverage, there are bad losses in different places. And then the question is, what are you going to do with those losses? In most cases, quite often, you know, don't mark them to the market. Don't account for them and recognize those losses, which is kind of, let's say, hiding those losses. And hoping in time, you know, it'll be fine. But that'll produce a squeeze. That'll produce a problem. I think we know those things, and that's happening at the same time as we have an internal conflict taking place, such as the presidential election, senators, congressmen, and so on, who are at each other's throats about this, who are going to fight with each other and fight to win. Not probably respect the rules as much, but fight to win for their side. And that's happening at the same time as we have the situation with China. Most importantly, China and Russia, the issues in terms of their things to fight over. For example, even there's going to be an election in Taiwan that'll also have a big bearing on this whole thing. We know, I think, that we're going to have financial problems and economic problems at the same time as we have this internal fighting and external risky situation happens over and over. The decline of the British pound as a reserve currency. Before that, the decline of the Dutch guilder as a reserve currency. All happened for the same reasons. Two things are going on. First of all, they're holding all of this dollars and the stuff that we talked about is going on. And then also there's the weaponization through sanctions of the dollar. In other words, the United States' greatest weapon to use, as distinct from its military weapon, is sanctions. And so sanctions mean you freeze other assets, you freeze assets. Those assets are the bonds that happen with Russia, and there are threats of it with other countries, China and so on. And there's kind of the thinking, well, if I hold the bonds, can that happen to me? And then why am I transacting in this other third currency rather than transacting directly? For example, the United States' share of world trade has declined and China's share of world trade has increased to become greater. So if two countries are trading, let's say Saudi Arabia is trading with China, why do they go to the dollars in order to do that? No good reason to go to the dollars. And then they're worried about holding the dollars because they might get sanctioned. So you see more of those transactions taking place in other currencies, and then the usefulness of the dollar as a storehold of wealth changes. Think about it in the most fundamental way. Everybody wants a medium of exchange and a storehold of wealth. So in other words, if everybody's using the dollar in world trade, then you want to save in dollars because you say, okay, now that's the thing, I spend it and I save in He dollars. But over time, as the share of world trade goes down, why aren't they denominating in like China has a larger share of world trade? Traditionally, the countries that have the world's reserve currency have the largest share of world trade and the largest share of world capital flows. And because the United States has declined, and also there's a worry about that holding it because of sanctions. I mean, just imagine how the Chinese must feel about having a lot of money in treasury bonds. I would be worried that I would be treated like Russia would be treated. It's not something I would want to hold as a safe asset. And other countries who might feel that they can get sanctioned. And for all those reasons, they're less inclined to hold. When we call dollars, what we're really calling is dollar debt. Because you'd hold dollar debt. What is a debt? It's a promised received currency. Now, getting out of those things and transacting in other currencies seems to be the safer thing to do. For those countries. And so that's the dynamic that's taking place. It's not an attack on the dollar. It's like, I don't want to hold those things. So very similar to British pound, you know, what happened is the British had the war and they were the most powerful empire ever in the world. And then World War II, and they came out of World War II financially in debt, a lot of debt. And who held the debt? All these countries held the debt. Because that was the residual from that. But they had a problem. They had a debt problem. They needed to print more money because it was too much of a squeeze. So it deteriorated. And, you know, they sort of said, please hold my debt. Please hold my debt. They went to Commonwealth countries, the part of those that were in the former British Empire. And then you have the Suez Canal incident where there's sort of a war and everybody realizes, well, hey, wait a second. That British Empire ain't the British Empire and they're heavily in debt. And then they say, I don't want to own that debt, and there went the British pound. So that's just how the mechanics work. The reason cycles exist is that the next stage has been determined by what has already happened in the prior stage.